Ladies and gentlemen, in this video, we will discuss Tesla stock, what you need to know heading into tomorrow, and how tomorrow could really change the market dynamic in a good or a bad way. But first, before we get into that, take a listen to what Tom Lee just said on CNBC today, that the recent rise in Bitcoin could just be a leading indicator of the rise that we're going to see in markets in December. Pretty interesting.
Strat Global Advisors Head of Research, Tom Lee, joins us on set today. Hi, Tom.
Hello.
So based on what Taneo was describing with regard to Bitcoin, what do you think that this most recent rally says about the overall risk appetite in the market right now?
Well, it's really telling us investors are pro-risk. I do think it also just signals how much capital has been idle for the last couple of years, either parked in money market cash or waiting to see if the economy survived. So I think Bitcoin rising is to me, breaking out of a holding pattern is a precursor to what the S&P is going to do the rest of the year.
Speaking of the moves in the broader markets, you say the road to 6,300 is paved with bumps. What do you expect investors to see ahead that may slow them down? What are some of the key markers that you're looking for?
Well, I think there's a lot of macro to digest the next 3 weeks. Tomorrow is the jobs report, and I think investors are fearful that it's going to be too strong because of the hurricane and seasonal adjustment, so it's going to be a big number. Next week is CPI, which has been running a little hot, and Fed Chair Powell spoke about that earlier this week. And then, of course, on the 18th is the FOMC rate decision. So I think once we're through these events, investors can actually then invest into sort of that Christmas Santa Claus rally. So I think 6,300 is still very doable.
So you're basically saying don't go away after the 18th because there may be some additional upside toward the end of the year?
Yes, or buy the dips, yeah.
So, you suggest there that we're in a good news is bad news for stocks environment. Why should the market be concerned if the Fed is going to be less aggressive in terms of cutting rates?
I think there's a conceptual change that the market has to get used to, which is, let's say earlier this year when the Fed started cutting, people thought, 5 cuts is good for stocks in 2025. So if the number gets reduced, it's bearish. I think as we get into 2025, the market's going to shift to thinking the fewest cuts possible next year is the best case because it elongates the dovish cycle. So I think we have to flip the script, but it's going to take some time.
But hasn't that been the case all year? Because in January of this year, the market was implying 6 or 7 cuts. We're only getting a few. We've slowed the pace. The 2-year yield is not that far below Fed funds anymore. So I guess my point is the market's already kind of registered that slower is better.
That's right. I think it's, I would just say it's not a consensus accepted view because, for instance, when Fed Chair Powell spoke about taking things a little slower, the market got weak and then maybe had a rethink. So I think it's going to take a while until markets realize 1 cut next year is actually quite bullish.
Are you surprised that equities haven't reacted to some of the political turmoil abroad, South Korea, France, elsewhere?
In some ways, I think the stock market had been already pricing this in because, as you know, this year has been a pretty significant divergence between U.S. versus Europe and U.S. versus emerging markets, and even China's sort of failed rally. So I think in some ways the market's not surprised. Maybe it was even pricing in this through currencies and equity prices.
Tom, I'm going to go back a long ways to our long relationship. Do you still even track active managers and how much, they're trailing their bogeys at all, and whether that's a factor in any way at the end of the year?
Yeah, in fact, we've been cleaning up that data because, as you know, in the last 10 years, there's been a big change in the number of managers. It's good. It's kind of a good and bad year because active managers that tactically went cyclical or more offensive or tech have been having banner years. We have so many clients that are beating their benchmark by 6, 7, 8. These are unheard of outperformance, but it's a small number because, as you know, when you look at the world more towards macro or market neutral, it's been very tough.
So Tom Lee said a lot there, and I don't normally just blanket agree with what Tom Lee says, but I do think he's correct in the sense of the stronger the data, the better for stocks. Okay. Now, yes, again, would markets need to get used to potentially less cuts next year in a trade-off of stronger growth? Yeah, perhaps that could catch some people off guards a little bit. But if you get strong data, that is good news for markets. Because let's be honest, are the markets trading at almost record high valuations because of Fed rate cuts next year? Absolutely not. We went from expecting 7 or 8 cuts next year to 3. We're currently expecting around 3 cuts next year, 2 to 3 cuts. We're not trading so high because of that. We're trading so high on markets in terms of evaluation because we're expecting growth is going to be good. And I do think that's where some of the risk could be in markets, is this expectation of really strong growth and a really strong labor market. Perhaps, let's consider, let's say tomorrow's jobs report is 75,000. Yikes. That would not be good. Current estimates are sitting at about 200,000 for your headline number for the month of November. Again, last month was only 12,000. People really chalk that up to the strikes at Boeing, as well as the hurricane that perhaps made that number come in, so low, almost negative. But just imagine if we get like 75,000 job ads, we massively miss the headline, and let's say November is revised lower and even goes negative. That, I think, is a much bigger risk than if the jobs report comes in at like 300,000. Okay, if the jobs report comes in at like 300,000, I think that would actually be bullish. And I think markets might fall initially in the trading day, but I do think you would rally back throughout the trading day. Okay, so that's the big risk for tomorrow, in my view, is we actually get a really weak jobs report, not a really strong jobs report. Now, that's not my personal opinion. That's just saying that, what's worse than the other? Is getting a strong jobs report worse than getting a weak one? No, I think getting a weak one is worse than getting a strong one, even though that means less cuts from the Fed. Because of where markets are currently valued and the expectations for next year, everyone's a bull. Everyone expects next year is going to be a good year, and it probably will be. I mean, the odds look like next year will be good. But if there's anything that kind of throws into doubt the bull thesis, that's where valuations become a problem. I say on this channel pretty regularly, valuations don't matter. They don't matter on a day-by-day basis. On any normal frickin' Tuesday where nothing is happening, valuations do not matter. Markets do not sell stocks because of valuations, typically. When valuations matter is when the information changes, okay? Like this market, we're priced for a very strong economy. That's why valuations are so high. If next thing we know, the economy is not as strong as we think, then valuations probably shouldn't be as high as they are, and that's when valuations become an issue. So I think that's the big problem heading into tomorrow, is actually a potentially weak jobs report versus a really strong jobs report. Now, for tomorrow's unemployment rate's currently at 4.1%. We are expecting that's going to move up to 4.2%. Again, the risk there is we move up to like 4.3%. Or 4.4%, something along those lines. And that would really, again, throw into question how strong is the labor market and how strong is the economy. You did see today that initial jobless claims came in higher than expected. We were expecting around 215,000. Last week was 215,000, so we were expecting pretty much no increase, and we came in at 224,000. Now, we've been undershooting. We've been coming in low here for a while, so it was bound to happen. Eventually, we would miss the expectations, and that's what happened today. I really don't think this is a big deal. I don't think this is a precursor to a really weak jobs report tomorrow, although it's starting to feel like we could get a weaker jobs report. Now, that's kind of interesting because Jerome Powell said the economy is strong yesterday. Fed Kugler said we may get a really strong jobs report on Friday. Like, there's been sufficient reason to expect a strong jobs report, and I think that's the most, base case assumption at this point. Now, you are seeing something interesting happen today, though. The Russell 2000 is down 1%. I think this is really in anticipation of what markets expect to be a good jobs report tomorrow and less easing from the Fed. Russell down about 1%. NASDAQ barely green, really being led by big tech, up 0.04%. The S&P 500 is down 0.02%, and the Dow is down 1/3 of 1%. Again, that's just really has to do with the expectation of a stronger jobs report tomorrow. What's also pretty fascinating is the AI Investor Sentiment Survey. We talked about this for almost a week now here on the channel, but last week for November 27th, you had the highest number of bears we have seen in a year. Okay, this was the 1-year bearish high on November 27th. That completely collapsed since then. Now the bears are at 30.7%, down from 38.6%, so down almost 8%. Neutral investors also fell from 24.3% down to 21.0%. And bullish investors skyrocketed more than 11% from 37.1% to 48.3%. So people did get a lot more bullish as we did go into December. You can also see today the percent of stocks currently trading above their 50-day moving average is at 62.11%, down about 2.5% on the day today, which is kind of in this range we've been trading in. It's kind of been zigzagging back and forth between the low 50s and the high 60s. So nothing is really dramatically changing today, but this is a day where the average stock is moving lower, and I think that's notable to point out. Over on StockTwits, sentiment for the SPY is bearish today at 39. Yesterday, you were bullish at 61, so sentiment is definitely falling today, and that's what tends to happen when small caps really underperform large caps. Message volume is high today at 60. Yesterday was high at 59. And the participation ratio today is normal at 53. We do have some earnings coming out today after the bell. Lululemon, that's going to be important just with the whole Black Friday, Cyber Monday weekend that we just went through. If they have good things to say, then I think that's good news for consumer stocks. UiPath, Ulta Beauty, DocuSign, GitLab, Hewlett Packard Enterprise, Samsara, Viva, Petco, and Asana all report earnings today after the bell. Gillahern Tavers on X says no one is buying it. Mag 7 just reached its lowest volume in years. The last time we had similar conditions, it was very close to a significant top. And I think that's a reasonable comparison. There's not a lot of buying activity in Mag 7 right now. Why would you be buying Mag 7 if you're expecting the market conditions that we are next year for growth to outpace Mag 7 or come close to that in the broader markets with valuations a lot lower in broader markets? The Fed's still in easing mode with less regulation, deregulation. All of that is positive for small and mid caps, a lot more than Mag 7. JP Morgan says with a high PE multiple on the S&P, we can expect muted 5-year forward returns. And I think that's really true because of the market cap weighting of Mag 7. I don't think Mag 7 is going to perform that well relative to small caps or mid caps or even an equal weight S&P. I think this is very much a stock picker's market and not a market you just want to buy the broad index. Jason Gopher on X says the S&P 500 hit record highs for the past 3 days. It also had more stocks declining than advancing each day. That's only happened 3 other times in almost 100 years. Even 2 days in a row is highly unusual. So when you see these phenomena, you do tend to see markets that go up for a bit afterwards and then go through a significant correction phase, right? So, I mean, take it for what you will. It's really just big tech that has the market weighting in the index that is allowing your index level stocks to fall, big tech moving higher, carrying markets to new all-time highs. Is this an investing strategy per se? No, it's not a great sign though for the headline S&P. Ryan Dietrich on X says Russell 2000 up 10.9% in November. This is the 22nd 10-month 10% monthly gain ever, and you were higher 6 months later 90% of the time, and up 11.3% on average. So Ryan Dietrich here is suggesting that history says the Russell could be up quite a bit over the next 12 months. Michael J. Kramer says S&P 500 price to book is basically at 2000 levels. And I mean, it is, which again is not a huge problem until you get something that derails the bull thesis, that derails the bullish narrative, like a weak jobs report, like a really low GDP report, or personal spending report. Something needs to happen to be a catalyst to make people care about valuations again. Eventually it'll happen. I think at least in Q1 it'll happen. But is it going to happen from tomorrow's jobs report? Probably not. I mean, you would need to see like a sub 100,000 jobs number and a negative last month number to, I think, really start to derail the bull thesis for next year. Everyone's bullish. People want to be bullish. And markets are willing to shrug off a data report here or there. Wow, and I didn't think I would see this, but David Rosenberg says the remarkable surge in the S&P 500 over the past 2 years has truly surpassed my expectations, especially in the last 12 months. Given that this bull market has persisted long enough, those of us who have found ourselves on the wrong side of the trade must consider adopting a different strategy. My latest memo is in no way a throwing in of the towel, rather an effort to discuss and interpret the message from the market that may not actually be altogether that irrational. David Rosenberg is one of the few people that has been bearish on this market for a while. And it looks like he's starting to grow more comfortable with what the markets are doing, which I think is a contrarian sign that we may be too bullish. CNN's Fear and Greed Index today is at 57, which is where it was yesterday, barely in greed, almost in neutral, which could theoretically, allow the markets to move higher. Overall indicators are not super, overbought anymore. They're generally reset back to a more reasonable level. So I think that is supportive of markets heading into tomorrow. Market momentum, extreme greed. Stock price strength is fear. Stock price breadth is fear. Put and call options, extreme greed. Market volatility is neutral, and safe haven demand is fear, as well as junk bond demand currently in fear. So what do I think this bottom line means for Tesla? Tesla had a great day today, broke out to a new multi-year high, was up around 4% on the day today. From a technical perspective, Tesla looks really good. From a pure catalyst perspective, Tesla looks really good. We can look out and say 2025 is probably going to be a really good year for Tesla. And thus, I think you're going to get a lot of positioning in December bullishly into Tesla. But again, the risk is tomorrow, if we get a really weak jobs report, then some of the bulls are going to say, oh crap, is this economy as strong as we think? Are we entering into another growth scare? We had a growth scare in September that sent the markets into a correction. That's the risk heading into tomorrow. If we get through the jobs report, if it kind of comes in line with expectations, that's the best outcome. Around 200,000, it shows the labor market is holding up. There's strength there, but it's not overly, heated, right? That's probably the best case scenario is 200,000 just meeting expectations. Maybe a little bit above that, maybe like 210,000, 220,000 would be pretty good as well. Worst case scenario is less than 100,000, in which I would expect the markets would sell off pretty aggressively tomorrow. I think bond yields would shoot up pretty aggressively on that. That's not my base case. That's not my, expectation per se, but I think that's the risk for tomorrow. So a better jobs report is going to be good for Tesla. A weaker jobs report is going to be bad for Tesla, as Tesla is seen as one of the more cyclical companies on our markets, right? If the economy does poorly, people are going to expect that Tesla will also do poorly. So those are kind of my thoughts. I think, there's probably an 80% chance the jobs report comes in really strong or in line with expectations, there's probably a 20% chance or so that it comes in just really weak, that Wall Street got this one wrong. The Fed's hints towards a strong jobs report on Friday were just them talking out of their ass, right? There's probably a 20% chance of that. And if that happens, that would derail a December market rally, I think, for at least a time, a stretch of time, whether that's a couple of days, a week or two. Don't know the exact specifics on that, but as long as we meet expectations and things are good, then I think that does green light a December rally for Tesla. And I think to start 2025, Tesla could easily be at new all-time highs. So let me know what you guys think down below in the comment section. That's going to do it for this video. Have a great rest of your day, and I will see you in the next one.